All right, so this is going to be the review for the midterm. What I'm going to do is I've got the questions in front of me, and I'm going to talk about a lot of things, but keep it focused on the test. I'm not going to obviously read the questions or anything like that, but I will make sure that we cover the subject matter that's covered in the questions. Some of it you might find kind of repetitive. There's like probably a few questions on opportunity cost. Couple maybe a few questions on liquidity. Those are things that are pretty important. You know, if you're the concept with trying to get ahead is obviously first you need some income coming in, but there's lots of people who make a fair amount of money, but for some reason or another end up not holding on to any of it or spend it on things that are it's just it can get quite expensive if you're not careful with your money. You end up spending money on things that are could be a huge strain to yourself. So anyway, that's opportunity cost. If you're spending money on, I don't know, cigarettes or whatever your subject is, even worse than that, automobile insurance is I'm always ragging on people about that. That stuff just, man, it's hard to get ahead when you're doing that big credit card debt. Anyway, so I'll go through the questions and and we'll just kind of knock things out. So we talked a little about insurance. We talked about auto insurance, homeowners insurance. Some of these things are just going to be terms that you'll kind of need to know. And deductible is a key term. Deductible means that amount that you pay before the insurance actually kicks in and starts paying. This is something, it's personal preference, decide whether you want a low deductible or a higher deductible, but it does definitely affect your rate. And like I say, it states a couple things. If you have a super low deductible, that might seem like a good idea, but look at your annual payments. You may actually, be paying significantly more for your annual payment in order to get that deductible. And then also, I think the insurance companies do look at that when you want a low deductible. It's like, oh, this is somebody who wants to file a fair number of claims. And one of their big costs is administrative costs. Even with automation, AI and stuff, it's still, just for a business to write you a letter or something like that costs like $7 or something. That's probably more than that now. But I've got a lawyer. Oh my God, if he answers the phone, it's a few $100s. It's like the administrative costs just get crazy. Um, One of the things about using credit cards or credit as a source of liquidity is you need to be mindful that, those insurance or those finance charges are going to rack up. If it's a credit card and you're using it, you realize you need some sort of emergency fund, but you don't necessarily want to keep, huge sums of cash in there because that's kind of silly. You'd rather have your money invested. And invested means perhaps a little bit less liquidity where you can't get to it that quickly. You can get to it, say, within a month, which is fine for a credit card because you can pay it off and not pay the insurance or not pay the interest. Anyway, not paying the interest. But anyway, so if you are going to use a credit card as kind of a component of your emergency plan, make sure that for it to be a good plan, that you have access um, to the cash to pay that card off within the month so that you don't incur the finance charge, which are very high, heinous, confiscatory, whatever term you want to use. They're far more than you can earn on normal investments. APR, APR is annual percentage rate. So if anytime you're doing anything with finance and they're quoting you a rate, make sure it says APR. Otherwise, it's meaningless. It's not. It doesn't have a distinct legal definition. APR does, but if somebody just says such and such interest rate and they don't, you know, follow it with APR or annual percentage rate. But anyway, that's got to be there in the document, and it will be there in the document, but probably not as prominently displayed as the teaser rate. They can vary in all sorts of little extra charges and stuff, and loan origination rates payments and loan processing and all these other things that you might miss because you're focused on the overall interest rate. But it's not really the overall interest rate. The overall interest rate is APR. That APR will uh, include all those items. Cosigner, yeah. If I didn't make the example of why you don't want to do it, one of the things, this is, what is this one of these true, false, kind of not true, false, but find the true one in here. It says the lender may not seize the assets of the cosigner. Oh, yes, they can. Yeah. When you sign as the cosigner, they have full, it says if you took out the loan. And obviously, since you're talking to a creditor, a bill collector, you took out a loan that didn't get paid. So you got a problem. And all those extra charges, you're on the hook for all of that. So try to avoid co-signing if at all possible. Um, Reasons to borrow funds. There's lots of good reasons, obviously medical emergency, but the problem with medical emergencies, you go right through borrowing funds to complete bankruptcy. It's the leading cause of bankruptcy. College education, that's not bad, your education, you're investing. Make sure it's in a marketable degree, but other than that, purchasing a car in order to enter the workforce. It doesn't say purchasing a exorbitant, a lab, whatever, a fancy car. So, but this last one about borrowing for everyday living expenses. Yeah, if you're just borrowing to get by, now it's I tend to get pretty deep into real estate, and I'll be, my daughters will laugh at me that I'm not living paycheck to paycheck, but I've got most of my money accounted for in mortgages and other investments, which is how I choose to live my life. But anyway, it's if you can't even tread water, if you're having to dip into um, what should have been your investments just for day to day regular occurrences, that's a problem. If it's some abnormal thing, if you're transitioning to a new job or moving or doing whatever, yeah, that's normal. But if you're in your sort of steady state living situation and you're borrowing money, that's a huge warning sign because that will end badly, given enough time. We didn't talk too much about checking accounts. People, to tell you the truth, you know, checking accounts are probably going to go away at some point in the future. It's just kind of a silly concept, between Venmo and tapping and everything else. Anyway, one concept though with checks is overdraft, and overdraft means because you can literally write a check for more than you have in the account, and which can be a bad thing because again it opens you up to a bunch of charges and other things. So you need some sort of overdraft protection because it will happen. Again, you don't want to keep a huge buffer of cash in your checking account so that will never happen because you're wasting capital. That capital should be invested. If it's just sitting there idle, at least you can get. I mean, you can get easily 5% with no risk. Just in some sort of money market account with your brokerage. If it's sitting there in a checking account getting little or nothing, point something percent, that's just not going to work for you. So anyway, you need overdraft protection. Usually it's tied to a credit card where it just rolls onto a balance and you go, whoops, screwed up there, and you take care of that credit card, but you don't get, technically in an overdraft, you kind of broken the law. So it's not that anybody's going to go to jail for one or two, but um, they can come up with these stupid charges, and again, you're on the hook for them because you whatever you screwed up. So if they say $70 for some overdraft charge, you can't say, well, that's outrageous. You crossed that bridge already. You just have to pay it at this point. So collateral is a great thing. It's what makes loans affordable. It gives security to the lender. So the collateral is that item identified in the loan. And so most, the loans that you want, the loans that have low interest rates are collateralized. They're secured. Loans that are done on your signature, it sounds impressive, but at the end of the day, the lender has nothing in terms of recourse other than some court process to go after your assets that are unspecified. Time's money and lawyers are money. Everything's money. So it's going to be a more expensive loan. So typically, you want collateral on a loan you want to be interested in. We talked about different types of insurance. Liability, which is just this liability means something that's happened to other people. Um, that's the legal requirement. Collision, that fixes your own vehicle. Again, it's optional unless your lender makes it a requirement since you've got a loan on the car. But then there's also comprehensive. And comprehensive is everything else. It's fire, wind, hail, stuff like that. It can be, I've bought a mammoth. It's like 50 some foot long aluminum horse trailer, and it was hail damaged. Totaled it out. Um, in somebody's mind. I'm not tall enough to ever see it. I'm not going to get on a ladder to look at it, but it's. I got a great price on it because it was aluminum trailer in a hailstorm in Texas didn't do so well, but that was covered by somebody's comprehensive policy. So anyway, finance charges, as I talked about before. If it's on a credit card, it only applies to the amount you haven't paid. So as long as you can run up your credit card, 10 grand per month, but as long as you have it paid in full by the billing date, um, the finance charges should be zero. So obviously you want to check every month to make sure that's the case, and if there's a problem, identify it. But if you paid it on time, you should be in the right, and those charges should be reversed. Um, how do companies, whatever banks, finance companies make money? They make money by loaning money at a higher rate, so they're charging you 8% or something, and they're paying, their saver, if you want to call that, but they're paying, a percent or two. That's where they make the money on that spread between the two rates. So they loan at a higher rate than they pay the deposit. Quick access to funds, liquidity. So liquidity means turning something into cash. So the ultimate example is obviously cash itself. I mean, that's done. You don't have to do any conversion. And the example that's typically cited as being um, illiquid is real estate, just because it takes a little, 6 weeks or so, and in the process, people can back out. It's cumbersome. But again, it just means that you put money in real estate that you don't need, tomorrow. And here's another one about budgeting. If your spending exceeds your income, yeah, that's it's only going to go one direction. So you need to reduce the spending. Be nice to make much money, but most people are already trying to maximize it or maximize it within the lifestyle they want. So you need to control your spending. Credit card statements. How often should you reveal them? I mean, you don't need to be obsessive, but you do. You can't wait till they show up in the mail. It's going to be a problem if there's some problems with charges. So you're looking for duplicates. You're looking for, you go back, and especially if you don't budget very well, you can kind of make up for it reviewing your credit cards and see kind of where the money went if you're using a credit card for a primary thing. And then the fraudulent charges. Again, those most of the time will get caught, but if you're looking at the balance, you'll see it in a heartbeat. You'll see a bunch of places because they tend to go in a cluster. If you get one fraudulent charge, there's probably going to be a string of them they're going to hit the card pretty hard, knowing that somebody's probably going to catch it. But if enough time has elapsed, about 3 days or so, they should generally get their money and have accomplished the goal of revenue off, or the credit card company. If you catch it within 3 days or so, yeah, the credit card company's going to have to eat those charges if they pay them. Here's just a basic math problems with a capital gain, and it asks whether it's long or short term. Long term, short term, and finance, personal finance, IRS, whatever, any kind of financial dealings. Long term means over a year, short term means under a year. Makes a difference in terms of, in this case, it's a stock sale. If it's under a year, you're typically paying 15% on your taxes. That's if it's over a year. It's long term. If it's under a year, you're paying whatever your normal rate is on the high end. So perhaps up in the 30s. So double. Um, Money received. So if you know what you know about compound interest, means like one of these lottery questions, would you like 100,000 today, or would you like 100,000 a few years from now? Yeah, obviously you get the money now, not only because of kind of a bird in the hand, but also um, if somebody was to give you 100,000 and you're smart, you will invest it, at least put it in a savings account, something like that, where you'll be getting compound interest, and so that money will be worth more. And again, compound interest means earning interest on interest. Fixed rate mortgages, yeah, that's the standard 30-year fixed rate. Um, I guess 15 years are also kind of popular, but if interest rates are low, I prefer the 30 myself. But anyway, it means that that payment is going to be the same for the entire length of that. It's due to the inflation effects of just the economy, it's actually going to appear to you that the real amount, or the buying amount anyway, of that money used in your mortgage is going to get smaller and smaller as time goes on. I mean, the dollar amount will stay the same. If it's $2,000, it's always going to be $2,000. But years from now, $2,000 won't seem like that much money. Whereas, your friend who went the pure rental route, his rent's indexed to inflation, and it's going to be, probably 4 grand by then at least. Oh, we talked about HOAs a little bit. Homeowners associations can be a good thing, can be a bad thing. They do have, covenants and restrictions that might prevent your neighbor from, you know, painting his house purple. I literally had my grandmother, the neighbor painted their house like this bright purple. There was no HOA, no zoning. It was easy to find her house after that because it was right next to this just whatever house. Opportunity costs. So, like I said, big topic. Um, what you give up to forego as a result of making a decision. So anyway, if you're making one decision, if you decide to go to whatever, a movie, not that people go to that many movies anymore, but if you went to a movie rather than study for the test, that's an opportunity cost. If you spend a bunch of money on, going out to a restaurant in terms of, rather than investing in it or doing whatever, it's just trade-offs. Opportunity cost means that there's a finite amount of time and a finite amount of money. And since it's finance, we're talking primarily money. It seems like when you're younger, you have, you know, the money is more of the finite, more of the limiting factor. Whereas you get older, you tend to have more money, but your time is more of the limiting factor. But anyway, the opportunity cost applies to either. It just means that given this finite resource, how are you going to allocate it? And if you do something with it, You know, you can't be two places at once, and your money can't be two places at once. So, yep. This question I might have to actually change here after a while. It's about purchasing an item with a credit might help reduce your tax bill. And right now it's just a home because a home mortgage is tax deductible. Credit card interest used to be tax deductible. That's gone and probably will never come back. But automobiles under the big beautiful bill, whatever. If you jump through all the hoops and buy the right vehicle and you know it's got to be new, it's got to be American, it's got to be all that other stuff, or at least American built or assembled in America, you might be able to have that tax deductibility. I guarantee you, when you go to a dealership now, if they've got a vehicle that qualifies, they'll be more than happy to let you know because you know obviously you're losing money if you don't buy this vehicle, which isn't quite the case, but it does help. Um, when you start retirement planning, obviously as early as possible. That gets back to the first day when we looked at those charts about compound interest again. If you start early, you know, if you invest, say, $500 when you're 18 versus 50,000 when you're, you know, in your 50s, I think that 500 probably might have caught up to that 50,000 by then. It's anyway, the numbers will surprise you. If you give money enough time to work, it will do big things. Yep, on health insurance, where do most Americans get it? It's typically done by the employer and the employee. It's sort of a shared thing in our group policy. So that is the one bright spot about health insurance, and that's the only reason our system even functions as well as it does is because most people have some sort of coverage at their workplace. And I mean, I get it. For a lot of you all, it might be a deal breaker in terms of who you go to work for. And employers, I think, kind of realize that. Stop payment on check. It's just a concept where if you, this has happened to me where somebody had written me a pretty large check for some equipment. And anyway, I was out in the field, whatever, and, you know, lost the check. And so it's kind of embarrassing, but it was a few $1,000s. So what I did was I, you know, contacted the client, pretty embarrassing, but said, look, this check is missing, but you know, I'll pay the $5 or $10 for you to go to your bank and put a stop payment on it, meaning that that check will not be honored if it's presented to the bank. If I was to try and swindle them and show up at the bank with that check, they're since they've got a stop payment on it, that check will not be honored, cannot be cashed, and then they just write me a new check. So it used to be a bigger deal when we didn't have automatic, you know, electronic check processing. Now that there's not as much of a float, there's not as much of an opportunity for a stop payment, but it still happens. Student loans, car loans, those are long-term liabilities, right? Because long-term, because those things are more than a year. Nobody gets a student loan and pays it off within a year, or a car loan or a housing loan. I mean, you could, but that is not the typical. So it's a liability because it's money you owe. You know, you have assets and liabilities. How do you measure somebody's wealth? Well, it's not by, you know, what you see around them. It's not like, oh, wow, they've got a new car. They live in a huge place. They must be pretty wealthy. No, the way you measure somebody's wealth is by net worth, and net worth is assets minus liabilities. So you can have somebody who's very frugal and is incredibly wealthy. Probably not a lot of fun, obviously, but um, they might be much wealthier than the person who has, you know, is surrounded by all sorts of items. So um, anyway, I'm not saying it's great to be, yeah, some miser that's going to take it all with them because obviously you can't. So the person who maybe enjoys it, but there's got to be a balance. It's like everything else. Best way to reduce your homeowner's insurance. Sometimes the best way to reduce any, the premium on any insurance is to increase that deductible if you can live with it. Again, if you have $1,000 deductible, I totaled out a car one time with the $1,000 deductible, and this was a few years back. And the lady, when I was reporting the claim, she's like, "You had $1,000 deductible?" I'm like, yeah, I kind of did. And she's like, "You didn't want $1,000 deductible?" I'm like, "Well, now I don't anymore." It's, I don't know whether it's lady, whatever. I, maybe it's a little unscrupulous on her part. She goes, "Yeah, yeah, that sounds like a mistake. I don't think you want it. I'm gonna fix your deductible here." So she fixed it retroactively. Mm, whatever, worked out for me. Yeah, I think she took it down to 500 or 250 or something because she was just shocked that I have $1,000 deductible. But I knew what I was doing. I mean, it made my it was a fairly fancy car. And I was in Europe and it's a Corvette. There's not a whole lot you can do without spending multiple thousands with something screwed up over there. Earning interest on interest, again, compound interest. So another concept that you need to understand. So it's kind of, multiple questions on it. Compound interest. An ARM, adjustable rate mortgage, something that you might want to do. I mean, as long as you can handle, let's say you're doing fairly well, you can handle your mortgage comfortably. Interest rates are a little bit high, but you don't expect them to go higher, so you kind of gamble here a little bit. You take the adjustable rate mortgage. So let's say the prevailing rate, like right now, is probably like 6% or something like that. An ARM might be 4.5, but if interest rates go up even higher, the lender can index that rate up higher. And so it's not fixed. That whole 30-year fix that I mentioned before, that doesn't apply here. You're that's on a yeah. So on a home mortgage, your payment might go up to from 2,000 up to 2,500, and then it might end up at 3,000, something like that. So you do not want to do this if you're just barely scraping on, barely able to afford this house, and the only way you can do it is by taking the adjustable rate mortgage. That's kind of a recipe for disaster, because if it does go up, you're not going to be able to afford the house, and you're going to lose it. But if you're doing fairly well, and you could actually afford a $3,000 mortgage, but you don't want to, so you take this adjustable rate mortgage and you're taking a bit of risk here. And if interest rates go down or interest rates stay the same, you're money ahead. So, like I said, I've done it before. It worked out the time I did it, but I was, you know, had some luck, and the market wasn't. The rates were already pretty high. They weren't going to go too much worse. But again, if I would have been wrong, it would have been a little painful. Time value of money, again, you know, money today is worth more than money tomorrow. Talk about insurance policy. If you've got some items and high value items in a category, you're not going to be sneaking it by the insurance company, and you're not going to be getting paid for it if there's a claim filed. If you've got something like that, a bunch of guns or camera equipment or whatever, you need to make sure that that is covered. When you're doing your taxes, the lowest rates for taxes are obviously varied because there's two potential income people coming in there. But there's also, if you have dependents, well, if you're single is the category that has the highest, percentage um, take. If you're making 100,000 as a single person, you're going to be paying a fair amount of insurance. If you're a single person that has a child or some sort of dependent that you're taking care of, well, then you can file under head of household and essentially get that married rate. So it's a better deal. Who pays the commission when you're buying a home? The real estate commission, which is typically 6%. That's the seller. So it does not cost you as the buyer. Um, Talked about the importance of paying off your credit card each month. We talked about which loans are the cheapest rate. And again, it's collateralized, and collateralized means the same as secured. Um, the most liquid thing, obviously, from our previous discussion, we know that's not real estate. Stocks are pretty close. Stocks, you can get the money in a couple days. Um, but cash is the most liquid. So cash would be the answer. Another question on opportunity cost. I'm going to go into it. We've kind of reviewed it enough. Here's something about a homeowner's policy and which things are covered. Uh, you burglarize, lightning hits it, hailstorm, a river near the house overflows. River as in flood. Flood insurance is not covered under a standard homeowner's policy. If you need flood insurance, you have to take out a separate policy for it. And it's, you know, I had flood insurance on this property for a little while, and FEMA, the Federal Emergency Management Agency, I guess it is, they went through and they reassessed the flood zone, determined I wasn't in a flood zone any longer. Then it made a huge difference. I think their insurance alone on the flood insurance was like $2,000 or $4,000. So you can do things to mitigate it. If you go down to Florida, you'll see houses built on pylons or whatever. And in fact, this house sits up on a raised foundation because of that. So if you can get the living space above the flood area, um, it's a little more expensive in construction, but if you can avoid the flood insurance, that's huge. Um, if you get a cash advance on your credit card, they're treated just like other charges. No, they are not. No, they typically assess 10% or so as a convenience fee right off. And then also there is no float. You It goes onto your balance and starts accruing interest from the day that money's taken. So yeah, if you need something, if you've got to pay some bill and you go, oh, I'll just put it on the credit card, or no, maybe I'll just, get cash on the credit card. No, a credit card is not an ATM card. It does not work like that. It is possible to get money on it, but it's not possible to escape the fees on that. Again, it's up to your credit card company, but yeah, they came up with the money right then, and they're going to start charging interest. Positive on credit cards, yeah, they are an excellent source of emergency funds for unexpected expenses. For the most part, they are. If the car breaks or something like that, um, you can at least get the car fixed, car back on the road, and then scramble around to get the cash to pay it off before the bill comes due. Monitoring your debt level, yep, you want to make sure that it doesn't become, too high to where you can't cover those monthly payments, to where you can't, live within your means, where you can't kind of tread water to keep things leveled up. Um, on insurance, why do we have insurance? Risk management strategies for insurance, avoiding risk, pretty hard to do. I mean, maybe I mean, I guess it could be a strategy. I'm just not gonna drive. I'm just not gonna. And it's hard, but I guess it's possible. Accepting risk, you can do that if it's a smaller item. You say, well, I've got the finances to cover this if something bad happens. The most common thing is to insure against it, pay a premium to a company that accepts the risk on your behalf. But the one you should not do is just pretend like it doesn't exist. That would be ignoring risk. You you need to, you know, see what the risk is and then decide what you're going to do about it. But to ignore it and pretend like it won't happen, no, that's not a good strategy. So that went pretty quick. That was 40 questions, believe it or not. Um, it's going to be multiple choice. It's going to be on Blackboard. Um, it's going to be timed. The exam will just cut off at the end of it. So if you get too wrapped up and you're jumping back and forth and doing stuff like that, it may shut down on you. It is Blackboard. If you do have a real problem, you can send me an email or a text or whatever, and I can reset the exam. But other than that, you know, it's not super forgiving the Blackboard program. It's going to be open up the entire week. I'll post the dates on there for you. Uh, the other thing is the homework. Get the homework turned in. Some of the questions, due to the different editions, they don't line up exactly. If you're really in doubt, don't stress about it too badly. There's usually a question in the book that's fairly close on the same topic. That'll work. Pick that one and answer that one and hand it in. I'm not machine scoring these, whatever. I look at your homework, so it's all gonna work. So yeah, turn it in and then open up the midterm and complete it. And good luck on that.